Cooperatives provide benefits back to their members through their unique business model. Members own the cooperative through their investment in and business conducted with the cooperative. Because of this, they control the cooperative through voting on key issues and serving on the board of directors. Members also receive benefits like patronage. So what is that?
Patronage is member-based profits that are distributed back to those members in proportion to business volume conducted with the cooperative. Typically, patronage business volume is measured in units, such as cents per bushel, dollars per ton, or dollars per gallon. Patronage is also an incentive for members to conduct business with the cooperative. So if the cooperative is profitable, the more business a member conducts with the cooperative, the more profits that member could receive back in the form of a patronage distribution. Before we talk about the different types of patronage distributions, it is important to understand the business relationship between a farmer and the cooperative. As members, farmers own the cooperative. So the cooperative is part of the farm enterprise's investment mix, such as farmland, tractors, or trucks. Because of that relationship, profits generated by the cooperative are only taxed one time, which is known as single taxation. That means cooperative profits are either taxed at the farm level or at the cooperative level. Who pays the tax is determined by how the board of directors distributes the cooperative's profits. That is an important advantage of cooperatives and patronage distributions. Cooperative profits and patronage distributions are only taxed once.
Patronage cannot be distributed before the cooperative's year end. Patronage comes from member-based profits, and the only way to know if the cooperative was profitable is after the cooperative's year end. At that time, the board of directors will determine how much patronage is available to distribute. Remember, the board of directors has the final say in how patronage is returned. Member-based profits can be distributed by the board of directors in three ways. First is to pay cash patronage back to the members. Typically, these cash payments are received at the cooperative's annual meeting. The second way is to have a retained patronage distribution that is held by the cooperative as an equity investment for the member. Retained patronage is often called allocated equity because a member's name is on that equity and the equity will be redeemed or paid back to that member in the future. That redemption process is subject to the cooperative's equity retirement plan. Finally, the cooperative can distribute member profits as retained earnings. If this occurs, then this equity is called unallocated equity because it does not have the member's name on it. The cooperative's name is on this equity or the cooperative has the claim.
Let's go through a straightforward example. Assume at year end a cooperative's grain department was profitable. The board of directors declares that 5 cents per bushel of patronage will be distributed to members. If a member sold 100,000 bushels of grain to the cooperative, then they would receive $5,000 of total patronage. Of that $5,000, let's assume the board of directors decides that the member will receive $2,000 in cash at the annual meeting, and the cooperative retains $3,000 of allocated equity that the member will receive in the future. Of course, this is an example. The decision of how much cash patronage and allocated equity to distribute varies across cooperatives because it is up to each board of directors to make that decision. Note that a similar example could be done for, say, the agronomy department or any department that generates member-based profits. But being profitable is key, because if a department does not generate profits, then the board of directors cannot distribute any patronage back to members.
Patronage is a tremendous benefit for members. It allows them to share in a cooperative's profits. Patronage also provides an economic incentive for members to conduct business with a cooperative. And the members who serve on the board of directors have a say in the distribution of these member-based profits. In short, patronage is an integral part of the success of any cooperative business.